Welcome back, everybody. Well, the narrative has shifted. Everyone loves big tech again, especially Google and Amazon, which everyone is saying are the obvious buys because they're trading at prices we haven't seen since, well, earlier in the year when I was adding them to my portfolio. But that's not important. I'm happy that we can talk about big tech again because I still believe they are the best companies in the market. And that's why my portfolio is dominated by them. Now, obviously, I agree that Amazon looks attractive. I've been saying it all year. And I also agree that Google looks attractive as it's trading slightly above the levels where I added it back in February. But I think there's one big tech stock that people aren't talking about enough, and it might actually be the best bargain out of everything in big tech. And that company is Meta. Now, I know I've talked about Meta before, but I just wanted to show you what I'm looking at, compare the fundamentals to Google and Amazon so that you can see what I'm talking about. Now, if we just start with some basic comparisons here, this is Seeking Alpha, this is on the Peers tab. And if we just look at the growth metrics between Meta, Google, Amazon, Microsoft, and Apple, you can see that revenue growth over the past year, Meta has had the best growth out of all the companies in big tech. And then projected revenue growth is also the highest out of the 5 companies listed. But we know revenue growth is just one aspect to it that doesn't tell the full story. So if we just take a quick look at earnings per share, we can see that year-over-year earnings per share growth for Meta was outstanding, with only Amazon being higher. And again, Amazon's profitability story has just been off the charts. That's why I added it to my portfolio. And then if we looked at projected earnings per share growth, again, Meta is the highest by quite a bit compared to their big tech counterparts. And then just to take a quick look at profitability, we see from a gross profit margin perspective, Meta is far and away the best company out of the 5. Now, obviously, it's dependent on business model. Some of these companies have a lot of different products and business segments where Meta is really just advertising. So again, it's not an apples to apples comparison, but when we're talking about where to put our money, you want to know the profit margin of the business that you're buying into. So I do think it's still relevant. Now, again, gross profit margin is just one thing. If we go down to net income margin, you can see that Meta and basically Microsoft are the 2 best in that category. And then from a levered free cash flow margin perspective, it's Meta, Microsoft, and Apple kind of all around the same general area. And now, again, this isn't some deep fundamental analysis. This is just looking at some basic stats. And the point that I'm trying to make here is that just on a basic stat level, Meta looks pretty attractive compared to their peers as it relates to just general growth as well as profitability. Let's take a little bit deeper look. So if we go to FinChat and we just look at their projected revenue growth over the next 2 years, it's about 16.77%, earnings per share at 27.88. And if we just compare that to, say, Google, they're at 12.16 and 22.42. So again, pretty good growth rate projections, but not as high as Meta's. And then if we just take a look at Amazon real quick, we see their projected revenue growth over the next 2 years at 10.7% and earnings per share at 41.38%. So again, Amazon's profitability story is a really exciting one. Let's dig a little bit deeper because one thing we know about Meta is that it's basically all advertising. So what I've done here is I've charted the advertising revenues of the big tech companies that have advertising as a main part of their revenue stream. So obviously Meta, it's pretty much their whole revenue is advertising at this point, which is an important point we're going to talk about here in a minute. Amazon obviously has a big advertising platform that's growing fast. For Google, I put both YouTube and Google Search in there because they're both relevant, I think, even though the primary one or the main one is Google Search. And then for Microsoft, I included LinkedIn revenue as well as search and news advertising revenue. Now, the first thing you can see from this chart is that Google Search by far and away is the biggest out of all of these. But next is Meta's advertising revenue. And the thing that's important about that is both Meta and Google primarily make the bulk of their revenue from advertising. Now, in Meta's case, it's like 98% of their revenue. In Google's, it's not that high, but it's still the majority. And so this is the reason why I think those 2 businesses trade for the multiples that they do. Because if we look at the multiples of these businesses, you can see that from a valuation perspective, they trade at much lower multiples than Amazon, Microsoft, and Apple do. Now, part of that could be just market sentiment and pricing, but I think this is true over time as well. And then if we look at their price to cash flow numbers, you see that Meta, Google, and Amazon trade at a certain level, with Microsoft and Apple trading at a higher level. Now, why does that happen? There could be a lot of reasons for that, but I think in general, it's about business model, right? So with Google and Meta, they're primarily advertising businesses, so that means that there's going to be some ups and downs in terms of predictability. Whereas with Amazon, they also have a large part of their business that's relatively low margin retail e-commerce, right? So I think that's why they generally trade for a lower multiple as it relates to price to cash flow. Now, for Microsoft, they have a very diverse revenue stream. They have a lot of subscription services. Apple trades for a premium, I think, because of the quality of Apple's ecosystem and how many people just really love their products and never want to leave. So obviously, that's not going to be every single reason why this is, but I think in general, what you find is that the multiple is going to reflect details about the business model that investors think are important. And specifically for Meta and Google, I think the reason why they trade a little bit lower in terms of multiple is because they're so dependent on digital advertising. And so if we go back to this chart, I just wanted to show you something. Now, I put this for the last 2 years on a quarterly basis, and you can see in general its growth. And down here, we can actually look at the compound growth rates. And we can see that over the past 2 years, Amazon's advertising services actually has the highest growth rate out of all of them at 20.73%, with the next one being Meta at over 16%, with the rest of them being under 10%. So what that means is that over the last 2 years, Amazon's ad business has been the fastest growing, with Meta a close second. Now, if we change this to just be the last 1 year, what we see is that surprisingly, Meta has actually had the fastest growing ad revenue business out of all of these companies, with Amazon obviously very close behind. Now, what's important about that to me is Meta is the second largest advertising business on this chart, right? So it's not like some smaller advertising business that's ramping up and grabbing market share. It's one of the leaders that is now growing faster than anybody else, even though it's already large. That to me is pretty interesting. Now, if you remember, Google was actually under 10% on the 2-year time frame, but over the past year, they've actually accelerated. So this is good news for Google as well, where their ad business, which is obviously the largest one on the chart, is accelerating over the past year compared to the previous year. But overall, I do still think it's pretty remarkable that Meta's advertising revenue is growing 20% over the past year when it's the second largest. I mean, that is pretty remarkable growth. And while this chart definitely helps us kind of understand what the growth rates are, one of the things that I like to do is dig into the details a little bit more in terms of the different segments, if they're there, just to understand how the business is doing at a more granular level. So if I go to segment and KPIs, and I'm going to turn the percent change on so I can see the growth rates, the first thing I'll look at is, look, advertising revenue is $146 billion of their $149 billion of total revenue. So obviously, Meta is an advertising business. It's totally dependent on advertising, and that's why I think that it trades for a lower multiple than some of their peers. And so if we compare that to Google, we can see in terms of Google search revenue, it's $186 billion out of the $328 billion in revenue that they did over the past 12 months. And YouTube ads is another, call it $34 billion in revenue. So while it's not as high of a percentage as Meta is, it's still the bulk of their revenue. And that's why, from Google's perspective, advertising is truly a critical business for them. But I think we know one of the reasons people are talking about Amazon and Google so much recently is because of the valuation that they're currently trading at. Now, we just go back to our peers comparison and look at the valuation. We can see that from a price to cash flow perspective, Meta, Google, and Amazon are all trading under 18. And in Meta's case, it's under 17. And so when you have a company that is a worldwide monopoly, which all these companies are in some way or another, and they're trading for less than 18 price to operational cash flow, then it's going to look interesting, right? Because they still have good growth rates, where in Google's case, it was obviously in double digits, over 10. In Meta's case, it was over 20. So that should be piquing investors' interest, even if they're companies that people think are too obvious. But as we know, operational cash flow doesn't really tell the whole story. So let's take a look at their cash flow breakdown to understand a little bit more. Now, this is a chart of Meta's cash flows, where this is cash from operations, this is stock-based compensation, and this is their capital expenditure. Now, we can look at the percent growth rates just to get an idea of what's going on. Their cash from operations is up 41.3% over the past 12 months. This is really good. Their stock-based compensation is up 13.9%. And while that is a high number, it's good that that growth rate is lower than the cash from operations growth rate, because you wouldn't want that to be flipped. And then from a capital expenditure standpoint, they're up about 7.9%. So at first glance, to me, that would tell me that cash from operations is growing faster than the other two, which is exactly what you want to see. Now, that being said, if we go quarterly, I think we see a slightly different story, because the year-over-year growth rate based on the most recent quarter, you have stock-based compensation at over 13%. You have cash from operations at just under 12%, but then you have CapEx at 33% growth. So that tells a very different story than the last 12 months told. This is basically where cash from operations is growing slower than stock-based compensation and much slower than CapEx. Now, Meta's already come out and said they're going to spend on CapEx because they're ramping up for AI. We already know that, but this is how that shows up in the financials. And so now let's take a look at Google and see what theirs looks like. Obviously, this is their cash from operations, stock-based compensation, and capital expenditure. If we turn on the percent change, we can see the stock-based compensation is up just over 6%. Cash from operations is also up about 6%, and then CapEx is up 57.8%. Now, this is over the last 12 months, so let's take a look at the quarterly view. If we take a look at quarterly, what we see is stock-based compensation is up about 1.6%. That looks good. Cash from operations is technically down 7%, and CapEx is up 91.4%. So in this case, I would say the story for Google is slightly worse in that they're really ramping up for CapEx, even though it seems they've got their stock-based compensation issue kind of under control, but the CapEx ramp is pretty high. And look, they told us they're going to do that. Sundar said the risk of not investing is greater than the risk of investing. So obviously, they're literally putting their money where their mouth is. But I think that's where it's an important point to say, look, operational cash flow is important. I look at it a lot, especially for Amazon. But you also have to understand that this CapEx spend is something that is going to eat at free cash flow. Now, the question is for how long? And I know people are saying, well, eventually this will go down. And I agree, eventually it will. They're in a very high CapEx spend kind of part of their cycle. But understanding that that free cash flow spend and the ROI on whatever that is going to be a big driver of what their financials look like in the future. And then lastly, if we just want to look at Amazon, I don't know why the colors are different on this one, but this is their cash from operations, this is their stock-based comp, and that's their CapEx. And if we just take a look at the percent change, we can see that stock-based compensation up only 3.4%, cash from operations up a whopping 74.6%, and CapEx up only 1.7% over the past 12 months. But let's take a look at this quarterly and see if that story changes. Stock-based comp is actually down 5%, which is great. Cash from operations up 53%, and then CapEx also up 53%. So, these shouldn't be surprises, right? These companies said they're going to spend on AI. A lot of that money is going to NVIDIA, which is one of my other companies. But at the end of the day, this is a story with the big tech companies. They're all spending a lot on CapEx, and that's going to impact free cash flow. Now, the good news for them is they're making a lot of operational cash flow. So they still have money for buybacks. They still have money to do all these things that they want to do. But I think what you see here is that these companies are all in a very similar kind of space in terms of the money that they're investing and how much of their money is going into CapEx and even stock-based comp. And from a valuation perspective, what you're seeing is they're kind of trading around the same levels. And yet you hear everybody talking about Google and Amazon and how great the buying opportunity is. Yet I never hear anybody talking about Meta, when in my opinion, their buying opportunity is just as good, if not slightly better, than the other two at this moment in time. And just to wrap up, to show you what I mean, this is my portfolio valuation sheet that I basically use every single week. I just put all my portfolio companies in there. And I think I showed you guys this before, but I'm basically taking their price to operational cash flow, price to cash flow, and I'm doing a price to cash flow to growth ratio, which is similar to the PEG ratio. And I'm just using operational cash flows for this for the most part. So again, it's not a perfect science, but it's good to be able to compare these three companies because again, they're all having big impacts to free cash flow because of CapEx. So if we just look at this, what you see is that Amazon just looks so attractive still even now. And it's because their operational cash flow growth over the past year and projected is so good. And so you see their numbers. I mean, both of these are under 0.5. To me, that looks extremely attractive. And if you look at Meta, they also look really good at 0.39 and 0.66. And again, if you look at their growth rates, it's been very good over the past year, but then also projected to be good. Now, the issue here with Google is that when you take in their growth rates, this doesn't look as good over the past trailing 12 months, but it looks better on the projected number. And the reason for that is if you look at Google's last 12 months operational cash flow growth, it's 5.97% or about 6%. And so that's really hurting them because all this is doing is taking the current valuation, comparing it to the actual growth rate, and then giving you a number, right? There's no magic to this. It's very simple math. But then when you look at their projected growth rate, it's much better. And that's why their price to cash flow to growth projected looks actually pretty attractive. It's less than 1. But again, Meta and Amazon to me look even more attractive just on that basic measure. But look, at the end of the day, all three of these companies are great companies. I hold all three. I like all three. I've been singing Amazon's praises all year. I bought Google back in February, and I think it's a great company. So anybody buying those companies, I definitely understand, and I think they're great. All I'm saying in this video is that I think Meta is just as good of an opportunity that hardly anyone is talking about, I feel like, where when you actually look at the fundamentals, you look at their growth rates, you look at the acceleration of their advertising business, which is already the second biggest, you look at the growth rate compared to their current valuation, it looks just as attractive, if not slightly more attractive than Amazon and Google. So if you're out there and you're looking for opportunities and you're like, you know what, I don't know if Amazon's for me, I don't know if Google's for me, but I want something in big tech, I would take a strong hard look at Meta because I personally love what they're doing. And I just think for a company that's so well known and usually talked about a lot, I feel like at least in the places where I'm looking online, they're a little bit under the radar compared to Google and Amazon, when to me, the fundamentals look really, really strong. So what do you guys think about Meta compared to Amazon and Google as it relates to growth prospects and valuation? Let me know down in the comments below. Now, if you want to see my original stock analysis on Meta, where I do a deep dive on their whole business, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.